Right now, somewhere on Wall Street, a trader is celebrating. And the money they're celebrating with came directly out of a retail trader's account at 82. Not because the market crashed, not because silver failed, but because that retail trader did exactly what Wall Street engineered them to do. They panicked, they sold, and they handed over their position at the mathematical bottom. What you're about to understand in the next few minutes will permanently change how you read a red candle forever. Most retail traders stared at that 82.017 close and saw disaster. Institutions stared at the same number and saw the opportunity they had been engineering for weeks. That gap in perception is exactly where wealth transfers from one group to the other. When silver collapsed to $82.17 on March 3, 2026, the dominant narrative in every comment section, every financial forum, and every retail trading group was identical. The bull market is over, the breakdown is confirmed, get out before it gets worse. That collective reaction was not a coincidence. It was the intended outcome of a precisely engineered price event, known in institutional technical analysis as a selling climax. A selling climax is not a random market accident. It is the mathematically inevitable conclusion of a sustained period of forced selling, where every category of weak-handed participant, the over-leveraged trader, the stop-loss hunter victim, the emotionally exhausted position holder, all hit their individual breaking points within the same compressed window of time. When those breaking points converge simultaneously, the result is an explosive surge of sell orders flooding the market at exactly the same moment, creating the volume spike and price collapse that defines a climax event. Here is what makes this critical from a market mechanics standpoint. Selling pressure is not an infinite resource. Every seller who capitulates at $82 is a seller who no longer exists in the market. Every stop loss that gets triggered is a seller who has been permanently removed from the equation. Every retail trader who panicked and hit the sell button at the low is a participant who transferred their position and their future profits directly into the hands of the institutional desks that were absorbing every single one of those contracts on the other side of the trade. This is the core mechanics of a selling climax that 99% of retail traders fundamentally misunderstand. They interpret the heavy selling volume as confirmation that the price is going lower. Professional traders interpret that exact same volume as confirmation that the selling is finished. The distinction between those two readings is the difference between selling the bottom and buying it. When a market runs out of sellers at a specific price level, the path of least resistance does not gradually shift higher. It violently snaps higher. And the traders who understood what $82 actually represented were already positioned for exactly that move. Every retail trader watching silver on March 3, 2026 was focused on one thing: the price, the red number, the 82.17 close, the dollar amount of pain sitting in their account. And that singular focus on price is precisely why most retail traders will never consistently read the market the way institutions do. Because the price is not the story, the volume is the story. The volume is always the story. The volume bar that printed on March 3, 2026 was not a normal market event. It was nearly double, in some measures triple, the average daily volume recorded across the previous several sessions. That single data point, that one abnormally oversized bar sitting at the bottom of the chart, carries more analytical weight than every moving average, every trend line, and every price level that retail traders were obsessing over in that moment. When volume spikes to that magnitude at a price low, the market is not sending a subtle signal. It is broadcasting an institutional-grade confirmation that something structurally significant just occurred. Volume at this scale represents the physical evidence of capitulation. It is the measurable, quantifiable footprint of thousands of retail participants simultaneously abandoning their positions under maximum emotional duress. You cannot fake that volume. You cannot manufacture it with normal market activity. That kind of volume only occurs when an abnormal concentration of sell orders floods the market within a compressed time frame, which is the exact mechanical definition of a capitulation event. Here is what makes this data point so critical for serious traders to internalize. In technical analysis, price can lie. Price can be pushed, manipulated, and engineered to create false visual narratives on a chart. But volume tells the truth about what is actually happening beneath the surface of that price action. When institutional desks are absorbing massive sell orders at $82, that absorption shows up in the volume bars. It cannot be hidden. It cannot be disguised. It is the one metric that reveals the actual transaction reality of what occurred that day, regardless of how the price movement is being interpreted in the financial media. The retail trader who only reads price saw a breakdown at 82ers. The professional trader who reads volume saw a buying climax, the precise moment when selling pressure reached its mathematical limit and institutional accumulation quietly overwhelmed every panicked seller in the market. That volume bar was not a warning. It was a confirmation. Most traders spend years chasing indicators, oscillators, and complex algorithmic systems trying to identify market reversals. But the most reliable reversal signal in professional technical analysis does not require a single indicator. It requires the ability to identify three specific characteristics that print simultaneously on the same candle. And when all three appear together, the probability of a violent directional shift increases dramatically. The first characteristic is volume, not slightly elevated volume, not moderately above average volume. Volume that is 2 times, 3 times, sometimes 5 times the normal daily average. This is the non-negotiable foundation of the exhaustion candle confirmation. Without abnormal volume, everything else is irrelevant, because abnormal volume is the only mathematical proof that an abnormal number of market participants just exited simultaneously under emotional distress. Normal selling does not produce that volume. Only capitulation does. And capitulation is what institutions have been waiting and positioning for. The second characteristic is a wide intraday price range. On March 3, 2026, silver opened around $87, briefly touched $88 in the opening hour, and then collapsed to $82 by the close. That is a $6 intraday range in a single session. That kind of price movement is not organic market discovery. It is the direct result of algorithmic stop-loss hunting, forced liquidations cascading through over-leveraged retail accounts, and panic selling compounding itself in a self-reinforcing feedback loop. The wider that intraday range on the exhaustion candle, the more violent and complete the capitulation event was, and consequently, the more explosive the reversal potential becomes once the selling pressure is fully exhausted. The third characteristic is the most sophisticated and the most important. It is the visible deceleration of selling momentum into the close. On the 5-minute chart of March 3rd, the most aggressive selling occurred between 11 a.m. and 2 p.m. Eastern Time. By 3 p.m., the price was still moving lower, but the volume on each successive 5-minute bar was visibly shrinking. By 3:30 p.m., price movement had nearly stalled entirely. That deceleration pattern is the market's most honest signal. It is the real-time confirmation that sellers are running out of ammunition, not accelerating, not gaining momentum, but exhausting themselves bar by bar into the close. When all three characteristics converge on a single candle, the market is not predicting a reversal. It is mathematically confirming that the conditions required for a reversal are already in place. That is the difference between speculation and high-probability pattern recognition. The most dangerous assumption a retail trader can make is believing that institutional price movements are random. They are not random. They are not accidental. They are not the product of broader market sentiment shifting organically. They are engineered, calculated, and executed with a level of precision that most retail participants will never fully appreciate. And that deliberate engineering is exactly what produced the $82 low on March 3, 2026. Consider the fundamental problem that every major institution faces when attempting to build a significant position in any market. If a large institutional desk wants to construct a billion-dollar long position in silver, it cannot simply begin buying openly in a rising market. The moment that buying pressure enters the market at scale, the price moves against the institution itself. Their own accumulation drives the price higher before the position is even partially filled. The cost basis deteriorates with every contract purchased. The inefficiency of open market accumulation at elevated prices makes the entire operation financially counterproductive. So the solution is not to buy into strength. The solution is to manufacture weakness. The institutional playbook is methodical, and it has been executed in this exact sequence for over a century. First, aggressive short selling is deployed over a period of days or weeks, steadily pushing the price lower and creating the visual appearance of a technical breakdown on the chart. Second, that engineered price decline triggers the stop-loss orders that retail traders have placed at predictable technical levels, levels that institutional desks have already mapped and identified. Third, as those stop-losses cascade and retail panic intensifies, algorithmic momentum traders pile onto the short side, compounding the downward pressure without any additional institutional effort required. And then comes the moment the institution has been architecting the entire sequence to reach. When the price hits the predetermined accumulation target, in this case $82, and the retail crowd is at maximum fear, dumping positions in a state of complete psychological collapse, the institutional desk quietly steps in and absorbs every single contract being sold. They cover their short position at a substantial profit. Simultaneously, they build the long position they wanted from the beginning, all at a price point that is 10 to 15% below where the market was trading before the engineered decline began. The volume spike at $82 is not a coincidence. It is the documented evidence that this accumulation sequence executed exactly as designed. The smoking gun was printed directly on the chart for anyone with the knowledge to read it. Wall Street does not beat retail traders with better information. They do not beat them with superior technology alone. They do not beat them with access to data that is unavailable to the general public. They beat retail traders with one weapon that is more powerful and more consistently effective than any of those advantages combined: a precise, deeply researched, institutionally refined understanding of human psychology. And on March 3, 2026, that weapon was deployed with surgical accuracy. The move down to $82 was not designed to reflect the fundamental value of silver. It was designed to produce a specific emotional response in a specific category of market participant. Every percentage point of that decline was calibrated to push retail traders through a predictable sequence of psychological states, from initial concern to growing anxiety to active doubt to complete panic, until the emotional pressure became unbearable and the sell button became the only option the brain could process. This is not speculation about institutional intent. This is the documented mechanics of how engineered capitulation events function at a psychological level. Institutions understand retail behavior with remarkable precision, because retail behavior is not random. It is consistent, measurable, and deeply predictable. They know that the majority of retail traders cannot psychologically tolerate watching an open position move against them by 10 to 15%. They know that most retail participants place stop-loss orders at the same obvious technical levels, just below recent swing lows, just below round numbers, just below key moving averages. They know that 2 or 3 consecutive sessions of negative price action will systematically erode conviction in even the most fundamentally sound thesis. They have studied these behavioral patterns across decades of market data, and they exploit them with the same clinical consistency every single time. One of the most costly misconceptions in retail trading is the assumption that the silver market begins and ends with the New York session, that the price action between 9:30 a.m. and 4 p.m. Eastern Time represents the complete picture of global supply and demand dynamics. That assumption is not just incorrect, it is the specific blind spot that causes retail traders to misread the post-climax setup entirely and make the most expensive decision of their trading cycle at the worst possible moment. Silver is a 24-hour global market. It trades across Asian sessions, European sessions, and American sessions, with continuous price discovery happening across every major financial center on the planet simultaneously. And critically, the institutional participants operating across those different sessions do not share the same psychological framework, the same media narrative, or the same emotional response to price action that drove the U.S. retail panic on March 3, 2026. When Asian markets opened approximately 6 hours after the New York close, the traders and institutions operating in Tokyo, Hong Kong, and Shanghai were not staring at $82 through the lens of fear. They were staring at $82 through the lens of opportunity. This distinction is not cultural observation. It is fundamental market mechanics. Chinese institutional buyers in particular have been aggressively accumulating physical silver for the preceding 18 months, driven by 3 converging demand forces that operate completely independently of short-term U.S. price action. The industrial demand story centered on solar panel manufacturing and electric vehicle production represents a structural consumption dynamic that Chinese institutions are positioning around with a multi-year time horizon. The monetary demand story connected to the BRICS coalition's systematic effort to build gold and silver reserves as alternatives to dollar-based settlement represents a sovereign-level accumulation strategy that does not pause because New York retail traders had a panic attack on a Tuesday afternoon. When European markets opened 6 hours after Asia, they encountered a chart that had already begun recovering from the exhaustion candle low. European institutional buyers added their buying pressure on top of the Asian accumulation that had already begun stabilizing the price. And by the time New York opened the following morning, the overnight session had already delivered the first confirmation that the exhaustion candle thesis was playing out exactly as the volume data predicted. The global dimension of silver market participation is not a secondary consideration. It is the precise mechanism through which the post-climax reversal receives its initial institutional momentum, completely beyond the reach and awareness of the retail traders who sold the bottom the previous afternoon. The single most destructive cognitive error a trader can commit during a sharp price decline is confusing a temporary interruption of a structural trend with a fundamental reversal of that trend. These are not the same event. They do not carry the same implications. They do not require the same response. And the inability to distinguish between them is the precise mechanism through which retail traders consistently exit positions at the exact moment institutional traders are aggressively entering them. Silver's move from $20 in early 2024 to $82 on March 3, 2026 represents a 370% structural advance. That is not a speculative momentum trade built on sentiment and narrative. That is a fundamental repricing event driven by the convergence of multiple independent demand forces, simultaneously overwhelming a constrained and deteriorating supply picture. A single red candle, regardless of its size, regardless of its volume, regardless of the psychological impact it produces in retail participants, does not dismantle that structural reality. It temporarily interrupts the price expression of it. The supply deficit that has been widening in the silver market for consecutive years has not been resolved by the March 3rd sell-off. Mine production has not suddenly surged. Recycling supply has not meaningfully expanded. The structural gap between what the market produces annually and what industrial consumption alone requires continues to widen with every passing quarter. That fundamental supply constraint existed at $93 on Friday. It existed identically at $80 on Tuesday. The price changed. The supply reality did not. The industrial demand picture driving silver consumption through the green energy transition represents a decade-long structural force that operates on a completely different timescale than daily price fluctuations. Solar panel manufacturing, electric vehicle production, and grid-scale energy storage technology all require silver in quantities that existing supply chains are already struggling to service. That demand trajectory did not reverse because algorithmic stop-loss hunting pushed the spot price down $11 in a single session. The monetary demand dimension, sovereign nations and central banks systematically diversifying reserves away from dollar-based assets and toward hard monetary metals, represents a geopolitical reallocation of capital that moves on a multi-year institutional timeline. Countries building strategic silver reserves are not liquidating those reserves because New York retail traders panicked on a Tuesday afternoon. Every structural tailwind that drove silver from $20 to $82 remained completely intact at the $82 low. The exhaustion candle did not change the fundamental story. It simply offered a more attractive entry point into it. There is a structural vulnerability embedded in paper silver trading that most retail participants do not fully appreciate until the moment it is used against them. It is not a hidden risk. It is not buried in the fine print of a brokerage agreement. It is the defining mechanical characteristic of leveraged contract trading. And on March 3rd, 2026, that vulnerability was exploited with the kind of precision that only becomes possible when institutional desks understand exactly where retail stop losses are clustered and exactly how much price movement is required to trigger a cascade of forced liquidations. When a retail trader holds a paper silver contract, whether that is a futures position, a leveraged CFD, or a margin-based brokerage account, they are not holding silver. They are holding a contractual obligation that exists entirely within a system of rules, margin requirements, and liquidation thresholds that they do not control. The broker controls the margin call, the exchange controls the liquidation threshold, the algorithm controls the stop-loss execution, and crucially, the institutional desk engineering the price movement knows exactly where all three of those trigger points are concentrated across the retail participant base. This is the mechanical reality that transformed the March 3rd sell-off from a market correction into a systematic wealth transfer. As the price declined from $93 toward $82, it passed through layer after layer of retail stop-loss orders that had been placed at predictable technical levels. Each triggered stop-loss added selling pressure to the decline. Each margin call forced additional liquidations into an already falling market. Each forced liquidation drove the price lower, triggering the next layer of stop losses in a cascading sequence that fed itself with mathematical inevitability until the final exhaustion point was reached. Physical silver ownership exists completely outside that system. A trader holding allocated physical metal in a vault does not have a stop loss that can be triggered. They do not have a margin requirement that can be breached. They do not have a broker who can force liquidation at the worst possible moment in the worst possible market conditions. They have metal. And that metal will remain in their possession at 80 taus, at 70 taus, at $62, for however long the engineered decline continues, without a single involuntary sell order being generated against their position. This structural immunity to forced liquidation is not a minor operational advantage. It is the foundational reason why physical holders consistently find themselves accumulating at the exact price levels where paper traders are being systematically stripped of their positions by the very system they trusted to hold them. The most expensive habit in retail trading is not over-leveraging. It is not poor risk management. It is not even the absence of a coherent trading strategy. The most expensive habit in retail trading is allowing emotional response to override data-driven analysis at the precise moment when the data is delivering its clearest and most actionable signal. And on March 3rd, 2026, that moment arrived with a level of technical clarity that the silver market had not produced in months. Every data point available at the $82 close was communicating the same message through a different analytical lens. The volume data confirmed that selling pressure had reached a mathematically unsustainable extreme. The price deceleration on the 5-minute chart confirmed that momentum was exhausting itself into the close rather than accelerating. The historical pattern data confirmed that identical structural setups across 3 separate prior instances had each produced violent reversals within 1 to 3 trading sessions. The fundamental supply and demand data confirmed that the structural tailwinds driving the broader bull market remained completely intact beneath the surface of the single-session price collapse. Every data point was aligned. Every analytical framework was pointing in the same direction. And yet the majority of retail participants ignored every single one of those signals because the emotional weight of a 12% open loss overwhelmed the cognitive capacity to process objective information rationally. This is not a character flaw unique to inexperienced traders. It is a deeply wired neurological response to financial loss that affects participants at every level of market experience. The pain of losing money activates the same threat response mechanisms in the human brain that evolved to protect against physical danger. And those mechanisms are not designed to pause and conduct a dispassionate volume analysis before generating the impulse to act. The professional trader's most critical developed skill is therefore not pattern recognition, not technical analysis proficiency, not fundamental research capability. It is the trained ability to recognize when emotional response is driving decision-making and systematically override it with structured data analysis. That skill is not innate. It is built deliberately through repeated exposure to high-pressure market conditions, through the disciplined documentation of emotional decisions and their consequences, and through the deep internalization of one principle that the most consistently profitable traders across every asset class and every market cycle have demonstrated to be universally true. The most profitable trades are always the ones that feel the most uncomfortable at entry. Maximum fear and maximum opportunity do not merely coexist at market bottoms. In a structural bull market, they are the same event. That volume bar at $82 was not a warning. It was a confession. Wall Street's confession that they had just finished accumulating everything they needed. The exhaustion candle does not mark the death of a position. It marks the birth of the next major move. And the only question that matters right now is which side of that trade you're going to be on.